contents from camera. Okay, there it is. Okay, I hope preparing your slides,
Yes,
loading your presentation.
yes, sir, we can see.
Okay, is that now visible?
Yes, sir. Yes, sir.
Is it in full screen?
Yes, sir.
Okay. So this is broadly the thing. Uh, how we will structure it is talk about Caspian. The unique thing about Caspian is that it does both equity and debt funding. So we'll first talk a little bit about Caspian equity, then we'll talk about Caspian debt. Then Abhishek had sent some questions to me about what I should speak. Based on that, I've made some few points. These are just bullet points or talking points. And finally, we'll conclude. So that is how it will be. So. Okay, so is this, I am seeing it in a different format. Is it full screen for all of you? Are you able to see?
Yes, sir.
Okay. So Caspian was established in 2004. It is the first of its kind impact investor in India. So microfinance as an industry began to grow in those days, but most capital came from donors or came from foreign funds. So Caspian was one of the first to invest into microfinance institutions. From there, it has diversified into becoming a debt company. We have a full-fledged Caspian debt, which is an NBFC. We cover many sectors. So agriculture is just a subset of what we do. Microfinance, small business finance, housing, food and agriculture, clean energy, education, healthcare. There's a long list of things we do. And food and agri comprises maybe 20% of our debt portfolio, and the rest is other things. As you may be knowing, in the VC world, you need to launch a fund, raise money, and then deploy the money. So in that manner, we have also raised multiple funds. The first of which was called Bellwether Microfinance Fund, and then a follow-on fund which was called India Financial Inclusion Fund, which invested into companies that you may know of, like Equitas, Arohan, Ujjivan, Janalakshmi. Many of these have become small finance banks. And Sonata, which recently was acquired by Kotak Mahindra Bank. So these are all the kinds of companies which we invested into. And affordable housing companies, again, a large number of those which are there, we were the early investors in those. Now, what will be of interest to you here will be the last point that at the moment, we have a fund called Caspian Leap for Agriculture Fund, and it is investing into early stage agri businesses. And that is a fund that I lead. And this is the active equity fund that we have. So the other equity funds that we have are up to the India Financial Inclusion Fund have been fully exited. The first two funds have been fully exited. All investments have been sold off or kind of exited by us and returned the capital to the investors. The Caspian SME Impact Fund is a fund that is fully invested. At the moment, it has Origo Commodities as one portfolio company, and EcoZen is another. GPS Renewables, so GPS is into clean tech. EcoZen is an agri tech company looking at pumps and solar cooling systems. And Origo is, of course, a commodity management company. So all these are the agri funds that we have fully invested. And there's no new investments we'll do. But under this Caspian Leap for Agriculture Fund, we are looking to make more investments, and that may be of interest to you, right? So what do we do? What is the investment thesis that we have? So the investment thesis that we have is that wherever we invest, into any company, we should be able to see the benefit to farmers from that. So the positive outcomes of our investment in the company have to be tangibly visible in terms of benefits to farmers. So that is why we only do upstream investments. So Zomato, these kinds of downstream investments we don't do. We only look at upstream investments, close to farm investments. So there you can see the details over there. Agri infrastructure, technologies that help production, productivity, and organizations with a presence on the ground. So as you can see, pure app kind of businesses don't interest us, or a pure market linkage company doesn't interest us. But if you're doing something in, let's say, improving the efficiency in water use, or improving productivity in agriculture, or reducing drudgery in agriculture, farm mechanization, these are things that interest us. And what we look for again is a professionally managed companies with teams that have the capacity to execute at scale. So these broadly are the things that would be of interest to you. You can ask any questions later on. It is sectoral agnostic as far as agriculture is concerned. That means we are looking at uh, agriculture, horticulture, uh, climate, animal husbandry, fishery, all these sectors are of interest to us. So that is where we are. A little bit about the investments that we have made so far. The first investment we made is in a company called Balwan Krishi, which is headquartered in Jaipur. And this company sells farm machinery and farm implements, where it helps farmers reduce dependence on labor. It reduces drudgery in agriculture, so you can mechanize operations which are otherwise done by hand, and that way they can help. The unique things about this company is that it sells equipment which are more durable, has after sales service, and these are affordable. So the typical cost may range from 1,500 to 15,000. There are equipment which are a lakh and above, but that's a small number. But these implements, as you can see again, we're putting out some information. We invested about 4.5 crores in this company, and since our investment in the company, it has grown to a 50 crore turnover business. Some of you who follow agri investment space would know that JM Financial has recently invested about 40 crore in this company, of which 30 they have actually invested, 10 they've committed. So this company is on a high growth path, doing well. Hopes to do about 100 crore turnover this year. So that's the first investment that we made out of our fund. The second investment that we made is called Kisan Vikas, or Agrosperity Tech Solutions, Kiwi for short. This is a Chennai-based company, and it is trying to solve the problem of agricultural credit to farmers and other players in the agri supply chain. So the small outlets, fertilizer outlets, or the seed outlets which are there in the rural areas who require credit. So we're trying to do that. At the same time, I think merely providing credit doesn't work. So providing market access for produce is also a uh, let's say, the services that need to be provided. So we invested in this company very recently in October of last year, and it has been doing well. There are other players like Samunati and Jai Kisan, which are also in this space, but we believe that there are different ways of providing credit to farmers than the way Samunati and Jai Kisan operate. So we have our own model of customized credit in a way that reaches farmers directly. The turnover of this company is not very great. It's about 30 crore and on the way to growth. It has a Japanese investor who has recently invested also in it. So good potential for growth, right? Uh, Apart from this, at the moment, we're looking at, we have not yet invested, but we are in the advanced stage of investing into a dairy tech company, a company that uses wearable devices on cows and buffaloes, whereby using various parameters that can be tracked with sensors, you can know the health condition of the animal and the estrus cycle and the fertility, when to inseminate the animal. And so that is the company that we are actively looking to invest in. Okay, so that's about Caspian equity. We've made two investments. We're looking to invest in one more, but overall, I think by the end of the fund, which is another 2 years down the line, we plan to make 8 to 10 investments. So we may plan to make another 4 to 5 investments in the next few years from Caspian equity. On the Caspian debt side, the NBFC that we have, it's a RBI licensed non-bank finance company. It provides debt to various sectors, as we were talking about. 20% of our portfolio is agriculture. It's not 20% by design, but because there are no more opportunities. So there's no limitation on our capacity to debt fund companies out of this NBFC that we have. We provide various kinds of debt. This could be, from the structure of the debt to the size of the loan to the repayment cycle. All of these are customized. And our portfolio is 95%. 95% of our portfolio is unsecured. So it is not backed by collateral, urban properties and all that, which typically banks ask. More than 90% of the companies that we have funded are first generation entrepreneurs. So they're not the conventional companies which banks lend to. The third thing is that in many cases, we are the first lender or the only lender to these companies. So it's a very unique portfolio that we carry of Caspian debt. Please do have a look when you find and see more about it. The debt products that we provide are loans from 50 lakhs to 15 crores. We do term loans, lines of credit, open lines of credit, purchase order financing. So you have a purchase order, you have to fulfill it. We do invoice discounting and supply chain finance. So many things. And we are into co-lending as well. Co-lending is what is now what RBI likes everyone to do. And we are also in that space, lending along with other NBFCs and banks to create portfolios for lending institutions. So that is where we are. If it's of interest to you, you should talk. I'm not part of the debt vertical, but we can. Clearly, I think when we have lectures like these, there seems to be an emphasis on equity. So everyone wants equity, thinking that it's a one-way route. वापस देने का काम नहीं है, So debt involves a responsibility to return the money, and therefore everyone wants. But if you look at the overall scenario, out of, let's say, around 6,000 odd startups in the agri space, only about 200 to 300, 200 to 250 have been funded through equity. And not everyone, it's not going to change. Not every startup in the agri space is going to get equity funded. But you can grow your business with the debt. So when does debt work for startups? When you have good gross margins. So If you have gross margins of, let's say, 25, 30%, you can grow with debt. If you have gross margins of 5% or like that, then debt may not work unless you're able to rotate the money every 1 week. So even if you have a 5% margin and rotating weekly, that effectively means 20% in a month, and you may be able to do it. But if a business has good gross margins, predictable cash flows, predictable cash flows basically means that the cash inflow from sales is predictable, because any borrowings has a repayment schedule that you have to respect. So there are due dates that you need to pay money on. On those due dates, you need cash to repay. So predictability in cash flow is very important. You may have great sales top line, but if your collections are not there, and customers with good credit history, that's an important thing. The customers that you deal with should be those which have a good credit history. Unfortunately, I think uh, you would also be interested to know that some of these so-called large startups, heavily funded startups, who again do business with smaller startups, are very poor at honoring their payment cycles. And if any startup has more than 50% business with government, we don't ever give a loan to them. Government is one of the most unreliable uh, paymasters, or does payments on time. So experience has shown, and if you are heavily reliant on government business, we are not lending to those companies. And when equity funding is not in sight, so equity funding, without equity funding, if you still want to grow, and this is something only smart entrepreneurs understand, So there are guys who will be chasing equity investors all the time, but there are smart guys who know that you can grow your business with debt also. Okay, when does debt funding not work? Pretty simple story. If your gross margins are low, it's debt is not for you. Creating of assets and infrastructure. You want to expand your distribution. You want to set up more units. Then you want debt for that. Generally, doesn't work unless you have long-term debt. R&D and technology. So you want to build an app. You want to do something. Invest into a tech team. Those are not something you should use debt for, because you don't know when those returns from the technology will come. And as a substitute for equity, there's many times the equity late हो रहा है, नहीं आ रहा है, तो debt से काम संभाल लेंगे types. Unless again you need to read both the earlier and this slide. If your business is a cash cow, it's generating cash, debt can be borrowed. But if your business is something which is burning cash, uh, debt is not a way to substitute for equity. So simple rules, understand that, and then go ahead accordingly. Okay. Yeah, so in our own portfolio, again, just to give you an example, some of the very successful startups that have grown with debt, I have put the names there. Bloomfield is into organic inputs. Mumbai-based production, I think, is in Nasik. Uh, they don't have investors, PE or VC investors, but they borrowed from us. Pasadi Panta is a new company which I think in the last 3 years has grown very well, dealing in spices and other commodities. Uh, Came to us looking for equity. We said we can't give equity, but are you interested in debt? The entrepreneur picked up debt from us and grew the business. Today, it's an attractive proposition for borrowing, for equity investment. So once you grow with debt, you become more attractive for equity investors also. Krimanshi is again a Jaipur-based company which is into animal nutrition, cattle feed supplements, and it has also, it hasn't been able to raise follow-on funding, but still with debt has been able to grow. Similarly, Bharat Rohan, another company which is based out of Gurgaon, originally from Lucknow, now moved to Gurgaon. They are into drones, hyperspectral imaging, and they've also been in the market to try and raise equity, but in the meantime, using debt from us, has been able to do well in their business. So these are companies, again, just to give you an example, that debt is also a product that works for you if you are in the right space. Okay. Now we come to the questions that Abhishek had asked, and which I tried to put a few points. Again, the caveat being that I am no representative of the VC industry. The VC industry is a very large industry, many players. We are just a small player in that space, but we're trying to just uh, understand what a VC investor will look at and answer these questions. So, what factors does a VC consider while evaluating idea stage or seed stage startup? So, the thumb rule of an investor is that the earlier we get into an investment in a company, the more profit we can make. So, if that company is still very small and still uh, not grown big, if we put some money into it, we will get a stake which is significantly larger. And when it is successful, then we'll make a big pile of money. So the thumb rule is to catch good startups early. In spite of that, idea stage or seed stage companies are not where VC investors want to look at too seriously. So this early stage, idea stage companies, it's left to incubators and accelerators and angel investors to look at. VCs do not, even if you try and let us say approach, send an email to someone omnivore and say that this is my idea, then 90% chances that you may not even get a reply to that. So uh, it's not of great interest to VC funds. That's also a reason why I am talking to you and not some omnivore guy or somebody else who is really a VC, not us. Deep involvement and engagement. The other thing is, why is the entrepreneur into this business? That is a serious thing. Is it just a fashion, a fad? Somebody has made big money, some Dehat has raised millions of dollars, or somebody else has become very successful. So therefore, you also want to try. Or how seriously are you into this line of business? That is an important thing. Are you ready to dedicate the next 10 years or 15 years of your life to do something meaningful? So that is what we try. And a keen business sense. So this is very important because a large number of the startup entrepreneurs do not come from business communities or from a business background. So they are from B schools, or they're from parents who are working in corporate or parents who work in government. And so they don't have a background as a family or as a community to be coming from a business side. So can these guys really do business is a question. They may do something very innovative. They may have a technology IIT degree, but with that IIT degree, will he be able to build a business? So these are things that we try to understand, and all these, there are no Q&As. So you can't ask a question and get an answer. So we try to evaluate these through multiple discussions, informal conversations, and see that does this guy or this lady have these kinds of skills. And about the product again, uh, whatever the product or solution. So the key to a VC investor is disruptive solutions. How disruptive is this, or how innovative is it? That is a question he or she would be asking in a VC. If it's a disruptive solution, it is of interest. If it is the routine thing which everyone is doing and you also want to do, aggregate and sell in the market, then it's a routine business. You may be able to raise funds, but it's really not of, because what VCs are looking for is outsized returns, what we call outsized returns. So if returns are 15%, then we can put it in any other business and still stock market is giving us more than 15% returns on a continuous basis. So why should I put my money to risk with this unknown entrepreneur and still get only 15% return? So I will want 30% or more than that. So that is how it is. How innovative is this business? Willingness of customers to pay. That's an important thing. Your solution may be great. Your solution may be relevant to the market. It solves something big, but the farmer is not ready to pay for it. Then who will pay for it? If no one is going to pay for it, at some point it's going to be a flop, right? So that is where it is. Is the solution scalable? Again, VCs bet on scalable businesses, not on businesses that are fancy and small and not able to scale. So how scalable is the solution is another question that we ask. And all these are questions that may be asked to you, but your answer is not what the VC takes. The VC does his own research, uh, cross checks information with the market, with experts, to see that these are of interest. Only if these are of interest will they proceed to engage with you. Okay. Do's and don'ts of pitching to uh, VC and angel investors is again a question that Abhishek said. So don't don't approach an investor without being prepared, right? So what is being prepared? So what do you do? What is your technology? What are your plans? All of these have to be there. How much money do you need? Typically, the VC will say, how much are you looking for? Do you have an idea for that? Uh, how much stake will you? Okay, he'll say, I'll put 5 crore in your company. How much stake will you give? Will you give me 50%? Now, you should be ready with some answer. You can't say, I'll come back to you and all that. So what do you value your company at? So these are things, if you're not prepared with these things, it's better not to approach a VC, because typically a VC conversation, an initial conversation will last 5 to 10 minutes, and they make up their mind, इसके इसके साथ आगे डिस्कशन करने का कोई फायदा है कि नहीं. They will make up their mind in 5 minutes, and after that, even if you try to reach them, they will not. So unless you're well prepared, you should not go. Socializing is an important thing. Socializing, not to go only when there is a pitch event or something. Many times there are let's say evening tea get-togethers. So in Bangalore or in NCR, you have these events that go on every now and then. Somebody conducts. Just land up over there, introduce yourselves, get to know these people. So don't talk only business. You become friends with these guys and then later on talk business. Customizing is an important thing. So every investor has his own kind of expectations about what he looks at. The strange thing about these pitch decks, all of them look alike. वो एक एक को 5 मिनट देगा, 20 लोगों को एक के बाद एक प्रेजेंट करने बोलेंगे. End of it, we don't remember anything because all are in the same structure, all are telling same story. So unless you are able to stand out from the crowd, you will be forgotten. So that is why you should be able to kind of impress the people who listen to you in the 5 minutes that is given to you. Focus on the problem. Again, this is what ये investors का VC investors का एक pet statement है. So I've just put it there that don't get too passionate about your solution. So you talk about the problem. Create curiosity. That is a big thing that we love. So in the 5 minutes that you speak, you don't give away everything. You create so much interest that the investor will say, "Isse chai mein, I want to talk to him further," or the investor will say, "Let's meet up." If the investor says that at the end of your pitch, that means you made your point. So the ability to create interest in the, if the investor while listening to you looks up his phone to see messages, you have lost him already. You can forget about investment. Uh, don't lie. This is one thing because we as investors interact with hundreds of startups. So we know the sector more than you, better than you, not because we are experts, but we listen to people every day on that. So if you're telling some bada story which is out of line with the market realities, you can easily figure it out. And don't reveal too much. Again, सब चीज एक बार में बता दोगे तो it is risky. You should always keep more details at the back for future conversations. Don't reveal everything in the first interaction that you have, and don't act desperate for funding. So ये पीछे पड़ जाना, जब पैसे दे दो, it doesn't work. Beyond a point, people will not only get annoyed with you, but will tell the peers in the industry that this fellow is a nuisance. So you should be able to hold your head high and say that if you want, this is a good opportunity. If you want, come and join, invest in us. Not to desperate say that if you don't give me money, I'll shut down. That is not the story that you should talk about. Broadly, this is where it is. And these are some general rules, not that these are written in stone from some years of experience putting together some thoughts. With this, I'll stop here, and as promised, about 40 minutes are past. If you have any questions or if you want to ask anything about Caspian or any other questions, I'm open to. Yeah.
Hi, hello, good morning, sir. This is Prabhu
Morning.
from Rover Sunday Private Limited from Tamil Nadu, sir.
Okay.
So we are into livestock contract farming with data analytics and AI driven projects, sir. So far we have given dispatched 100 plus quotes in 10 villages across 40 farmers contract been signed, and all these animals are will be monitored through our data analytics system to make sure the animals are getting progress properly, let's say goats and all. And whatever the produce is coming, we have agreed share between farmers and our company. So we will be investing on animal, and we do contract, and we do veterinary support, and feeding back end support also we provide, and buyback offer we are providing along with it. So we done a pilot of 40 farmers, and so far it's been 10 villages, and it's have a capability to expand pan India also. The farmers, 30 million Indian farmers are partially or fully dependent on goats and cows, animal wealth in this householding. So that is scalable, and through our system only it is possible to monitor such a big project or whatever it is. So we are actually looking for fund equity or debt. We already secured 3 NRA investors as a debt only, short-term debt loan. And so my question is, sir, before this session also, before 2 3 days, I visited your website, and I looked at all these things. And I have a question, sir. As a debt, so what would be your expected return in terms of yearly?
So we don't fund such early stage businesses. So a business we fund would have, if it is a product company, around 5 crore turnover.
Okay.
And if it is a service company, at least a 2 crore turnover, SaaS company, right?
Okay.
And typically having at least 2 balance sheets, audited balance sheets. So those are the requirements. If that is fulfilled, then we can give again debt funding. Our interest rates range from 16 to 18.5%. And that is plus a processing fee of 2 to 5%. So it's not cheap, but it's not expensive as such. And it's people come to us because there's no one else in the market. If you can get a better deal than that, please go ahead. So that is where we are. Early stage below that, we do not do. We do 50 lakh loans as I presented. When these come through incubators, so we have arrangement, for example, with Will Grow or others.
Okay.
So at the back, we have a guarantee system. So Will Grow guarantees the fund for the loan to partially guarantees to us.
Okay.
And in such cases, we do smaller ticket loans also to highly risky companies. But on a pure commercial basis, 5 crore turnover, 2 audited balance sheets, profitable or not even profitable, but at least if not profitable, having a decent cash runway is the requirement that we have. Yeah.
Okay. Good, sir. Thank you. Thank you so much.
Thank you.
Hello.
Yeah.
Yes, sir, thank you so much for the very practical and straightforward advice, sir. My name is Mahavir, and
Okay.
our company age is about 4 years. And
Hmm.
we have raised a mix of like about 70 lakhs, mix of mostly grant and equity
Hmm.
seed fund. And we have mostly focused on our financial sustainability in the past 3-4 years.
Hmm. Hmm.
And now we are somewhere at 2 crore ARR and will be
Hmm.
closing at 4 crore ARR, sir, this year.
Hmm.
And
Hmm.
so my question to you is like, how does the age of the company matters? Has it got any relevance when it comes to VC investments?
There is no, again, there is no standard rule. There are companies like, you know, WeGrow. You must have heard of a company called WeGrow. If you have not, you can
Will grow,
see
will grow, sir. Will grow.
VEGRO,
Okay,
not
okay.
Wilgrow. Wilgrow is a what do you say? Incubator
Yeah,
sort.
we have raised some fund from will grow. Yes.
So WeGrow is a company which was equity funded on the day it was registered. It was VC funded on the day it was registered. So there is no rule that there should be some age of the company before it is. It is a function of the VCs knowing you, more to do with relationship rather than to do with business. So if you know the VCs and the VCs know you, they will call you and give you money also. If not, the thing is the business model has to be, let us say, stabilized. For example, you've just given me some numbers now, but what you do, you've not told. So the business model, if it is stabilized, it is scaled, it is profitable, nobody else is in this space. You guys, the VC thinks these guys have a tremendous capacity to execute. Then they'll put money even in the early stage of business. So no issue like that. So there is really no age. For a debt, age is important because you need in equity, there is nothing like repayment. In debt, there is a repayment that is involved. So we have to be able to get our money back also. So on the equity side, age is not a relevant factor.
And for the debt, the bottom line got to be very positive.
No, no, no. We fund at least 50% of the companies we fund are not in profit. But why we invest or why we lend to such companies is because they're backed by very solid equity investors. So that is why we believe that the equity investors will rescue the company in case of the worst scenario.
Okay. Okay, sir. Yes. Thank you so much.
Thank you. So what do you do? What business are you into?
So we are into end-to-end supply chain management of the milk, sir. We are into
Ah,
organic milk. Yes. So
okay,
we have a
okay.
traceability part in that. We control the production and we control
Hmm.
the supply chain of the entire this milk, sir. So we
And
have unique.
in
Yes.
which place are you?
We are operating in Rajasthan, sir. 4 cities
Oh,
that
okay,
includes Jodhpur, Ajmer, Udaipur, and Jaipur.
okay, okay.
So
Thanks, thanks.
we actually recently, I mean, my experience with VC is little less. So So recently I approached a VC. So and he's a good friend of one of my mentors, a good friend. So they said ki, so his question was, why have you not raised fund in past 3-4 years? So so I was actually not very prepared for this question, and the reason is simple. It is because we were like very focused on the financial sustainability of the business. So
Correct,
we are not
correct.
fund dependent now, but yes, to scale, yes, investments are needed.
Makes sense. So you are not in a great hurry to grow. You want to build it in a robust manner. So that is your approach to business. Yeah, yeah. ठीक है.
So but now we are in great hurry to grow, sir. Earlier we
Ah,
were in
correct, correct. So that
our
is
core
the
focus
way.
not to be dependent on the industry.
Yeah, that is the way to be. Now, of course, you have approached VCs, and you should kind of keep a record of what type of questions they ask. If you meet all VCs, there are basically a stock 20 questions they will all ask. So after some time, you will know, you will be ready with answers. Not difficult. Whether they invest or not is another story. Okay.
And sir, this VC, not VC, but an angel to whom
Hmm.
I just spoke few days back.
Hmm.
So they have shown very positive interest in investing about quarter to crore, so about 30-40 crores.
Hmm.
Sorry, 30-40 lakhs.
Hmm.
And he's also interested in like maybe some other angels or small stage investment companies can join
Hmm.
the this round.
Hmm. Hmm.
So maybe like as you said, Caspian is interested in the early stage investments.
Hmm.
So will also
Yeah,
be
yeah. So
reaching.
we are not at this stage that you are in. We can look at, but maybe not so much immediately. The
Yes.
thumb rule for you should be not to dilute more than 10 to 15% in the initial round. So your ownership stake should not be reduced less more than 20% in any case in the first round of fundraise.
Yes. Yes.
Okay, okay.
Yes. Yes. Thank you so much, sir. Thank you so
Thank
much.
you.
Any other questions from participants?
How many do we have participants in this session?
We have 25 participants, sir.
Okay, okay, great. Yeah, yeah. So maybe you will have questions later on. This is where you can reach me anytime.
Good morning,
I
sir.
will.
There is one question.
Yeah, yeah, yeah. Go ahead.
Yeah, one quick question. This is
Hmm.
Kostlendra from FTSG Innovations. So
Hmm.
generally, when we raise equity, there is a valuation behind it. So valuation is
Hmm.
done for that. But
Hmm.
when debt is raised, again, do we do the valuation, or it is like on what basis debt is given?
Okay, so debt is given two factors we take. One is called leverage, right? So depending on how much equity you have, equity bhi nahi hai, equity minus accumulated losses, whatever, net worth of the company into multiplied. Uh,
Okay.
so typically companies like us are okay with 10 times of the net worth also. So companies like Samunati can go up to 20% of net worth. So that is one formula. Second thing we look at is cash flows. So what is the business cash flows? How much cash do they have? How much cash will the business generate over the next whatever life of the loan? Because all repayment has to come from cash flow. So these are the two metrics broadly we look at and create some optimistic scenario, pessimistic scenario. The problem with the debt is our relationship should not be strained. पैसे वापस collect करने में रिश्ता खराब हो जाएगा. That is one thing. Second, if we give a company which is not able to repay debt, it will sink. We do not want to kill a company by giving debt. So we're very careful about evaluating the entrepreneur, the business, and the capacity, the need for debt, then provide debt. So we do a lot of background work before providing debt, basically because of this, that the company and the entrepreneur should not be burdened with a debt which they cannot repay.
Okay, yeah, thank you, sir. And the interest rate is a fixed one, or it based on the profile of the company?
It is variable, but within a small range. Because NBFCs, the cost of capital itself is around 10.5%, 11%. So our borrowing cost, we are not having our own money. So we have to borrow, then we have to load on that the operating cost and the risk cost and some profit margins. So four things have to be added on that. Ultimately, our lending rate is 16.5 to 17, 18. We don't go more than 19. So 16.5 to 18.5. For financial companies, we could go to 14%, lower end. For companies that are bigger and we know their businesses are not going to be highly risky, we could reduce the interest rate. So that is the range. Yeah.
Yeah, okay. Thank you so much, sir. Thank you.
Thank you. Thanks so much. Okay, so again, I would say that I looked through the profile of the companies that are in the audience here. Some of them are grown and scalable also. Some of them are early. I'm sure what I spoke is relevant to all of you. Please do get back if you still have some doubts and questions that you think need to be answered. I'm available anytime. I guarantee that I will respond to any mail or WhatsApp message that comes my way. Thank you for this time, and enjoy your training at NIAM, and all the best with all your business that your plans that you have, and have a great day and a great weekend. Thank you.
Thank you so much, sir,
Thank you so much.
Thank you, sir.
thank you so much, sir, for taking time out for our startups. And
Thank
we
you.
look forward, we look forward to your sessions also in future. And also if they want to connect on one basis, they'll share the
Sure.
details.
Sure. Okay. Bye-bye.
Thank you. Bye, sir.